Welcome. In this video, Zbcn coin may start an uptrend. What is the reason? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand. When we closely examine the chart, we can see that the price movements have started to display a very promising and positive structure. Especially the recent developments offer important signals about the market's direction. The most striking of these is that the price has now formed a higher high. This kind of structure is considered quite significant in technical analysis, as it typically indicates that the market is evolving toward an upward shift. In other words, this higher high can be seen as the first sign of a potential uptrend. The formation of this new high suggests that buyers have become active again, selling pressure has diminished, and upward momentum is beginning to build. However, forming a higher high alone is not sufficient to confirm an uptrend from a technical perspective. For this structure to continue and strengthen, the price must also form a higher low. If this second structure also takes shape, meaning the price creates a new low without falling below the previous one and then begins to rise again, then we can confidently say that a clear uptrend is in place. In technical analysis, an uptrend is defined by a series of higher lows and higher highs. The formation of these patterns provides investors with confidence, increases belief in the market, and clearly reveals the price's upward potential. The next step for the price is quite critical. It's important to observe whether a new higher low will form. If the price finds support at a certain level, receives sufficient buying reaction there, and begins to rise again, then a clear higher low pattern will be established on the chart. This is considered one of the most important technical signals indicating that the trend has officially reversed to the upside. At this point, confidence in the market increases, investors expand their positions, and the price begins to gain momentum. This process may also lay the foundation for the start of a rally. From an investor psychology perspective, this development holds great importance. When an asset remains in a downtrend or sideways trend for an extended period, most market participants become impatient, lose hope, or shift their attention to other instruments. However, the formation of the first higher high followed by a higher low reignites expectations among investors. People begin to believe the price is turning a new page, and this belief helps market movements become healthier and stronger. Technical analysts patiently wait for these kinds of structures to emerge, as they can mark the beginning of major upward moves. Moreover, this upward structure is not limited to the price chart alone. These kinds of reversal formations are often supported by fundamental analysis as well. For example, positive news flow, sector-based growth reports, favorable economic indicators, or institutional buying can provide tailwinds behind this technical pattern. In such cases, technical and fundamental analysis work hand in hand to offer investors a more secure path. Especially for those looking to take long-term positions, this kind of scenario is ideal. It should be remembered that every major trend has a beginning, and that beginning often starts with small but meaningful technical formations that many investors fail to notice. A higher high structure, like the one we are currently observing, can signal this transformation. The next low the price forms will show us what kind of movement to expect after this high. If the structure is completed with a higher low, it could ignite the spark for a much larger upward trend. In such cases, patient and attentive investors can interpret these signals accurately and develop much healthier and more profitable strategies. To sum it up, the fact that the price has formed a higher high is a very positive technical development. But we can't base our entire analysis on just this. Let's now take a look at other metrics. Stay tuned. The Elliott wave theory is one of the most powerful analytical models developed to understand the structure of price movements in financial markets and to predict future direction. According to this theory, waves in the markets form in a specific pattern, and the most fundamental building blocks of this structure are waves 1 and 2. Especially for significant bullish moves, sharp upward price actions, to begin, these two waves must be completed. This is because the first two waves not only form the foundation of the structure, but also give the first signals of confidence that has not yet fully formed in the market. Wave 1 typically begins with the actions of quiet but cautious buyers. This initial rise often goes unnoticed by most investors but leaves a visible mark on the chart. Wave 2 is a natural correction that follows this initial rise. Although many might perceive this correction as a downturn, it's actually the groundwork for a major upward move. At this stage, there may be some hesitation in the market, and some investors might think that the first wave was a false breakout. However, if the price does not fall below the starting point of wave 1, it indicates adherence to Elliott's rules. As this structure solidifies, preparations for wave 3 begin. These are perhaps the most exciting times for investors because Wave 3 is often the longest and strongest movement. But for this potential to materialize, Waves 1 and 2 must be fully formed and confirmed. In other words, for the market to enter attack mode, a clear structure between Waves 1 and 2 must be observed. This structure influences investor decisions both technically and psychologically. Wave 1 represents the early movers, while Wave 2 brings in investors who are more hesitant but looking for opportunity. With the completion of these two movements, a clear low and high form on the chart. This helps analysts more easily identify Wave 3, and the real breakout comes with Wave 3. Wave 3 is the part of the Elliott structure where the strongest and most aggressive move occurs. During this wave, volume increases, investor interest rises, technical indicators begin to generate positive signals, and the market generally enters a noticeable rally phase. However, for this major wave to form healthily, the first two waves must be properly and rule-compliantly developed. If Wave 2 breaks below the starting level of Wave 1, the Elliott wave structure is considered technically invalid. That's why Wave 2 is closely monitored. If the price finds support at specific Fibonacci retracement levels during this wave and shows signs of recovery, we can interpret this as a signal that Wave 3 is approaching. Therefore, the formation of the first two waves is not just a prelude, but also establishes a solid foundation for Wave 3. This structure gives investors confidence because Waves 1 and 2 indicate that the balance of power in the market is shifting, both psychologically and structurally. The reaction movement that comes at the end of Wave 2 signals the beginning of a new phase in the market. This allows investors to reassess their positions and reshape their strategies in line with the new trend. In short, for the Elliott structure to initiate a healthy and strong uptrend, the first two waves must be completed thoroughly. These two waves plant the seeds of the uptrend. Wave 3 is the stage where these seeds sprout and grow into a tree. Therefore, great care should be taken when analyzing the formation of these first two waves. When these structures are identified on the chart, major opportunities can arise for investors, because Wave 3 is where both momentum and price movement are at their strongest. One of the most notable technical developments on the chart is the price's movement towards the 200 EMA level. The 200-day exponential moving average is an extremely powerful and notable indicator that determines the direction of the long-term trend in the markets. This indicator is closely followed by the vast majority of investors, both to restore confidence and to confirm direction. In particular, a break above this level indicates that the market momentum is on the upside and that the broader investor base is now embracing this asset. A reversal of the price from below the 200 EMA back towards this level could be considered as a reversal signal. This indicates that previously the price had a weak outlook below this average, but now the momentum is shifting. If a successful break above this EMA is achieved and sustained, this is usually a harbinger of a long-term uptrend. This is because this level is considered a trend line by both algorithmic trading systems and manual technical analysts. Moreover, it is considered not only bullish, but also the beginning of a permanent and stable trend. 200 EMA is a must for long-term trends. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.